Welcome, good afternoon, everyone. Welcome to the final session of the Plato MI3 Market Innovator Conference. We've got two presentations this afternoon. The first is a paper titled ETF Trading and the Bifurcation of Liquidity. It's written by Jonathan Brogard, Davidson Heath, and Da Huang, all of whom are at the University of Utah. We're fortunate today to have Davidson Heath here to present to us. Davidson's an assistant professor at Utah. So over to you to tell us about ETF liquidity.
Thanks very much, Carol. Thanks to all the organizers, and thanks for putting us on the program. It's a great pleasure. So this paper is motivated by a fairly simple stylized fact, which was kind of a surprise to us. And most academics, some academics we've talked to have said that they know about it, but to most academics it was a surprise. It was a surprise to us. It's not a huge surprise to most industry participants, but apparently. But to get everyone on the same page, this is when you take the Aminud measure of price impact, calculated stock by quarter, and you sort all extant US common stocks into three terciles, low, medium, and high, and just tell me what was the mean. It looks the same for the median, and there are other ways you can compute the measure. You can see that since in the last 20 years, right, in the most liquid and medium liquid terciles of common stocks, there's been a significant improvement. This is on a log scale, you'll notice. So this is actually an 8-fold improvement, starting all three out on the same baseline at 1, okay? There's been about an 8-fold improvement, roughly speaking, in liquidity, lowering of price impact in the high and medium liquid terciles of stocks. Over the same period of time, there's been no change, and in fact, arguably a slight worsening of liquidity, higher price impact on net compared to 20 years ago in the least liquid tercile of US common stocks. And there's a similar, although it's not maybe quite as clear, pattern if instead of the Aminud measure of price impact, you instead use the effective bid-ask spread that that market participants face, okay, calculated from the high frequency data. And in both cases, you can see that the three patterns of liquidity kind of move, in parallel for the first 5 years or so of the sample, up to about 2005. And then there starts to be this significant divergence between them, okay, where with the lowest liquidity tercile of stocks getting away from the other two. Okay, now so that's what we're sort of talking about. And as I said, among industry participants, when we present this paper at industry conferences and actual market participants, there's kind of we generally sort of see nods in the audience and people saying, yeah, I know about that. But this was a new fact to us as academics anyways, okay? It will not be any surprise to anyone that if we plot the total AUM in assets under management in US equity ETFs over the same period, that trend is not a surprise to anybody. And in this paper, we're going to focus, there have been, quite a few studies looking at the effects of, the rise of ETFs. And in some cases, they look at, let's say, ETF holdings, those studies, right? They look at which stocks ETFs tend to hold, okay? That's their sort of measure of treatment variable, okay? And in some cases, the key independent variable you can think of is of other studies is the raw trading volume in a given ETF or in ETFs as a whole. Okay. Now in this paper, we're going to focus on, you can think of our key independent variable being so-called primary flow, which is to say the actual post sort of at the end of the day where the ETF provider in some sense nets out the creations and the redemptions, the net creation and the net redemption, okay, for each individual ETF aggregated across the universe of all ETFs. So that's what this graph is plotting. And, we see a possibly, interesting kind of correlation in the data where net, it's no surprise that with, huge amounts of net inflows over those 20 years, that the creations have outstripped redemptions, but there are still plenty of months or quarters or days on which some ETFs experience redemptions. So that's why you see at the same time that the majority of ETFs on net experienced creation events, that is to say money flowing in, okay? And we're gonna argue that ETF primary flow in particular should be, and does appear to be, closely linked to asset liquidity and also to asset kind of market quality of underlying index assets in a way that is precisely tied to asset liquidity, those assets pre-existing kind of levels of liquidity in a way that's consistent with the data, okay? So then that's the evidence for that the rise of ETF trading is leading to this sort of bifurcation in stock liquidity, where the most liquid stocks are getting more liquid and the least liquid stocks are getting less liquid, okay? So there's a large and burgeoning academic literature on the subject. We know that ETFs seem to cause sort of increased return correlations among index assets, that the rise of ETFs is linked to higher individual asset volatility, price volatility, and lower price efficiency. There are those papers out there. And there's another working paper that, as I said, focuses on ETF holdings and finds that on average ETF holdings of your stock are correlated with higher liquidity. And we can talk about that. Our mechanism and our results are in some sense sort of, pick your favorite word, either orthogonal or perfectly consistent with, both orthogonal and perfectly consistent with the Wermers et al. Results as well, I think. Okay, there are relatively few papers. A couple of our favorites are Brown, Davies, Ringenberg, and Pan and Zhang, recent JF paper, where they're actually talking about, well, what is the mechanism by which the ETFs have these effects on the underlying asset markets? Okay, and we think our paper kind of contributes on both scores. Okay, so I didn't cite the gigantic theory literature and growing theory literature theoretically dealing with the consequences of the rise of passive investing. But one thing that you'll notice if you survey that literature is that most models of passive investing, sort of theory models that people have written down, tend to assume that whatever passive fund they have in mind has an index, and that index, market index or some other idiosyncratic index, the fund is just going to replicate that index pro rata. The weights that the fund will hold or seek to hold are identical to the weights of the index, okay? And the starting point for our theoretical investigation was actually an old friend of mine who ended up working in an ETF shop, and I were talking, and he said, or it came up that this assumption was in some paper we were discussing, and he said, why do you think I have a job? He said, that's not the case. He's a PhD in finance, and yet he ended up working on ETF implementation strategies, okay? And, if I handed you $1 billion, quick thought experiment, if I handed you $1 billion and said, okay, start replicating the CRSP value weighted stock index, starting today, you wouldn't immediately, right? Introspection suggests you probably wouldn't immediately hit bids, and you wouldn't immediately lift all the offers that you could find and try to perfectly replicate. You would be strategic about it. So this is in I think a fidelity.com white paper that Da and I came across, my co-author and I came across a little bit after that discussion, and we just thought it was pretty great, right? Because it suggests that we're probably right about this, because here's this Fidelity white paper that says, hey, you can actually sample your underlying index assets in an effort to, statistically replicate your target index. And in so doing, the trick is, right, to optimally balance expected trading costs, right, which increases in the number of, in this case, they were talking about bond ETFs, but the point is more general, along with tracking error, which goes down in general with the number of underlying assets you include in your basket. Okay, so that's the model in a nutshell. Okay, we say there's N assets in the market. It's a very, very simplified, focusing on the intuition, one period excess return model, and you have a funds face an externally specified vector of weights that's the index, and that's the sum up to 1, okay, as you would expect. In the model, there's free entry, okay, to become an ETF provider, and the ETF provider's only job is to publish a basket every day, which is a vector of weights W, not necessarily equal to V, right? And the ETF provider says, I will create or redeem, shares of the ETF in exchange for that basket I've posted, the W's, okay, at the end of every day. And they have, let's say they incur some costs in so doing, but because there's, free entry in the model, that means that the returns to being an ETF provider get competed away, very quickly to 0, which, seems like a reasonable first pass. We think that the ETF industry, the market for being an ETF provider seems pretty well populated and pretty competitive. Okay. In the model, there's one or more APs, authorized participants, who are granted access to the create redeem mechanism. The AP on any given day or in any given microsecond increment, it may, but is not compelled to, make a market for that ETF, for the ETF shares, right? And then they post a bid and an ask if they do. And when they get hit or lifted, they sell or buy respectively the underlying assets, okay? And at the end of the day, the net position gets closed out via the create redeem mechanism, okay? And so it follows that the AP's expected profit from posting, an offer that's above the NAV per share by B, the spread is going to be 2B, the bid-ask spread, right? This is how it works out. And then when you compute it out, competition between APs is Bertrand competition. So as long as you have at least 2 authorized participants, they make 0 returns in equilibrium, okay? And the bottom line is that the bid-ask spread is then precisely pinned down, at least in our nice simple model, by the expected trading costs of the basket that you post. And the ETF provider is going to solve for the basket that jointly minimizes the expected bid-ask spread, because they want investors to want to trade their ETF, and investors in the model prefer a lower bid-ask spread. And investors in the model also dislike tracking error. So the ETF is going to solve, the provider is going to solve for the basket of weights W that jointly minimize those 2 quantities in expectation, okay? And so I'll spare you the math formulas, but the bottom line is that very clearly dropping out of the model is that the basket weight relative to the index weight is decreasing in the expected trading costs. You will underweight or omit illiquid assets, okay? It is increasing in the assets correlation with the index. And this wasn't totally intuitive to us until we realized, well, wait a second, as the ETF provider, if there's an asset that's highly, highly correlated with the index, right, then by buying it, I'm kind of getting like extra bang for my buck, right? Because it helps me in terms of tracking the index over and above its individual idiosyncratic tracking or idiosyncratic contribution if the correlation with the index is high. Okay, think of the limiting case of this is if a futures contract on your target index exists, right? That has perfect correlation with your index, and you would love to put that in your basket. Okay, and the predictions for volatility are sort of ambiguous. So we run some regressions looking at actual ETF holdings in the data, and there's very clear, it's probably not that shocking that, the model does seem to capture the correct intuitions. The effective spread, which is to say the trading costs of a given asset, it's much more likely that a given asset will be, index asset will be omitted from the ETF's holdings. Similarly with correlation, although it doesn't pop statistically, but there's some reasons for that. We can tighten up the bolts. And volatility sort of goes it's ambiguous, but one of the two channels matters more. And in the most recent version of the paper, where we've actually managed to get a hold of actual ETF baskets on a daily basis, we see even stronger, even clearer support on all three. Okay. So next, on top of this fairly simple model of the ETF industry for a given index, a single given index, we're going to model trading behavior and see what are the consequences for asset markets. Okay, those individual stock markets. So traders in our model are 100% uninformed, which we think is, again, we're going to be working on at most a daily frequency. We're working on a very short, time horizon here. So if any given investor were informed actually and had some like private information about returns, we suspect that that's going to be a small enough effect, right, that in the data it's not really going to matter that much for what we're looking at, right? We're going to model pretty much all demand for trading the ETF as on our time horizon, it's uninformed. Okay, so think of it in that way. And initially, the traders in our model are trading the individual assets, and they can also so-called homemade index, in the sense that if they're interested in tracking the index for some reason, they can do it by themselves in a homemade way. And then when the ETF in the model is introduced, traders can but are not required to make use of it. Okay, and so what comes out of the model is that there's basically two effects of introducing the ETF into the market. Okay, the first is the netting effect, and that, the key insight there is just that initially for the homemade indexers, you have, let's say 10 homemade indexers who on net end up buying and 10 who end up like selling to them, right, or something like this. They're going back and forth. Or let's say on net the homemade indexers are 12 end up buying and 10 end up selling. So on net it's a +2. Okay, certainly at least an expectation when they're dealing with each other and with the market makers and the individual assets, each of those traders, right, is potentially paying the full cost of entering the market, crossing the bid-ask spread for the individual assets, and carrying out their trades, right? On the other hand, when they are able to trade through the ETF, right, at the end of the day, the AP, the authorized participant, or authorized participants plural, are going to net out the individual order flows. And to the extent that the AP can net out those individual order flows, they save on the execution costs, right? And because the market is competitive, the APs are competitive, that those savings get passed on to investors. So that actually improves overall net liquidity. The demand effect is that more individual traders come in, okay, because they, unsurprisingly and consistent with the real world, the introduction of the ETF lowers net trading costs for investors who wish to trade the index, okay, and therefore it's popular. So the model has the main prediction that we focus on in the model is that as a result, right, because the ETF's basket is tilted towards originally, the more liquid set of assets and away from the illiquid assets, as we predicted and as we showed in the data, that there's going to be this Matthew effect, or this bifurcation of liquidity, right? Because when the ETF is introduced, trading activity gets channeled into more liquid assets and out of less liquid assets, and that further exacerbates the difference. Okay, And so those are the predictions in the model. How do they look in the data? Well, we'll see some, some regressions soon enough, but let's just look at the kind of the raw data as much as possible. That's what I've always liked. So if we take the universe of US common stocks, okay, in our sample period, which is roughly the last 5 to 10 years, somewhere in there. Think of it as quite recent vintage data. And we're going to separate them. We're going to sort the universe of US common stocks into quintiles of their liquidity as of last month. So that's a proxy for like their expected trading costs over this month. Okay, so the stocks that had the best liquidity, the Apples and the Googles of the world, last month are still going to be very highly liquid stocks this month. Here's the relationship between that big aggregate measure of like total ETF primary flows that I showed you, that the expanding graph with creations and redemptions. Okay, here's the relationship between that and their subsequent liquidity, their effective spread for the most liquid stocks. You can see there's no, this is actually, you can do this in log spreads, you can do this a bunch of different ways. There is literally no significant effect there. So they're unaffected. On the other hand, the medium liquid stocks in the third quintile, there is, you can see in both directions, that as ETF primary flow on days, I think this is, where ETF primary flow creates and redeems were lots and lots and lots of creates, or lots and lots and lots of redemptions, that it just worked out that way, and summed across all ETFs. You can see that there was this small but clear and significant relationship of wider effective spreads, that is to say worse liquidity in the medium liquid stocks. And in the fifth quintile of the least liquid stocks, allocated as of last month, okay, you can see this very strong effect. And interestingly enough, it's stronger for redemptions, right, relative to creations. And that seems reasonable in the sense that on average, ETFs are kind of planning for maybe some small positive amount of new creations and new money flowing in every month. And when that doesn't happen, when they experience a redemption, it causes them to, do a bunch of trading and soak up a bunch of extra liquidity, potentially. Okay, so here's the big ugly graph now, which is attempting to sort of control for all other, major factors. Okay, and we can see that this is all presented. This is the change in the effective spread, okay, on average, within each of the liquidity quintiles, sorted from most liquid last month to least liquid as of last month. And here you can see very clearly this differential effect, that days when ETF primary flows on net were large in either direction. So that's the absolute value there, is like, we're trying to capture that V shape. We're saying if on a day where net ETF creation, primary flow, or redemption was large, okay, across the whole market, you can see this tilting effect where the spreads got slightly better in the most liquid sets of stocks and significantly worse for the least liquid sets of stocks. Okay, this holds both in the negative and the positive direction, and it also holds for trading activity, for share turnover. Okay, you can see here are the 2, 5 and 6 are the main relations for share turnover, and you can see not much of an effect on total turnover, but total turnover trading activity falls significantly on days when investors primarily were flowing in and out of ETFs. Okay, so more ETF primary flow on a daily basis is associated with, in both directions and regardless of how you scale it, a relative drop in turnover and liquidity in the most illiquid stocks in the market, just like the broad graphs that we showed at the start. Okay, now there's plenty of other things that vary that could be driving, right, both ETF primary flows and stock liquidity. That is to say, suppose that on days when there's a lot of new market moving news, some very important presidential tweets or something, right? Investors are, eager to lay off risk or eager to change their position on a more aggregate macro basis. So they trade ETFs preferentially. And maybe at the same time, there's kind of some differential effect on stock liquidity, right? Because market makers say, oh, I'm going to, face more informed trading, more informed orders, and that's going to be hitting the less liquid stocks more severely. Okay, so that's a potential, confounder, potential alternative story that suggests that we're just picking up an association in the data, but the ETF flow itself is not causing the changes in liquidity. So to try to sort of get a handle on that, we controlled directly for the returns of the market on a given day, interacted with the liquidity quintile main effects. And in a second exercise, we actually just dropped all days out of the data where the market moved more than 0.5%. Okay, so these kind of relatively quiet, stable market days. And in fact, the results are, in the first case, the results are unaffected. And in the second case, where we keep only quiet days in the sample, so-called no news days, the results actually get significantly stronger. Okay, that differential association gets like noticeably stronger on no news days, not weaker as you would expect if that alternative story were explaining our results. And, of course, market fragmentation and the rise of HFT trading and battle bots has, been another huge, pattern that's happened over the last 20 years. So we directly control for those using measures of market fragmentation and HFT activity measured stock by day. We put those in as controls. And again, our main results are, essentially unaffected, which suggests that those are not, explaining our results. Those are not confounding our explanations. Okay, and you can see that there. Okay, finally, a unique prediction that comes out of our model is that it should matter what kind of ETF the primary flow is flowing through. Now, some ETFs, as we said, explicitly say we statistically replicate our index by sampling the underlying assets. Some ETFs, on the other hand, I think Vanguard is fond of these, say in their prospectus and seem to from their holdings data, fully replicate. And they say we fully replicate our underlying index, and our holdings reflect the index roughly pro rata as much as possible. Okay. On the other hand, I defy any of you if I name a particular ETF that you like. I don't know. I gave it away with Vanguard, but let's say the Guggenheim Partners small cap, value ETF. Okay, I defy anybody in the chat or in the audience to tell me offhand whether a given ETF is a replicator or a sampler. So from investors' point of view, that's immaterial, right? But what we're saying is that from the point of view of the impact on underlying asset markets, there should be a significant difference there. Okay, now there's a little bit of a asterisk here that we have to worry about, which is that the fully replicating ETFs tend to be very large, and they tend to track highly liquid indexes of highly liquid, large cap indexes, SPY, VOO, QQQ, IWM. These are all fully replicating. This is a set of, large optimized so-called or sampler ETFs. Okay, and you can see that on average they're significantly smaller. And take it from me that they track a more diversified, wider index. Okay, so we have to adjust for the fact that we may be comparing apples to oranges there. Okay, so to do that, what we do is we go through and each year we construct as many pairs as we can of matched funds that have the same detailed 4-digit crisp objective code. Okay, so think, again, a small cap value ETF or something, right? And one of them is a sampler and one of them is a replicator, and their AUMs are at the start of the year are not too different from each other. So we're hoping that the other aspects of these ETFs, such as their target index and their size, are well matched. Okay, and the broad statistics suggest that we do an okay job of that. And when we split our approach and we look at what are the effects and what are the associations with primary flows, creation redemptions on net, for replicator ETFs versus sampler ETFs in our set of matched pairs, we actually find the effect is much smaller, and in fact goes the opposite way for spreads among replicator ETFs. But among our sample of sampler ETFs, okay, we have they're driving, the sampler ETFs, at least in this subset, are the ones that are driving all of the differential effect effectively that we find. Okay, so that is consistent with our model. It's difficult to tell a story whereby there's some other stuff like market moving news or HFT activity or something that is so different between the replicators and the samplers. So this is really the tightest evidence we have that this mechanism is actually going on in the data. Okay. So I will quickly talk, being slightly unfair to our discussant Zhuo, I will use my remaining 1 minute, if you don't mind, to talk about some hot off the presses work that we, literally in the last week or so, we've been working on. So what we would really like, right, is a so-called instrument, some variable, some market factor that plausibly drives ETF primary flows, right, but is uncorrelated with other things like expected returns, liquidity, information arrival, things of that nature. We would like some sort of market factor that ideally would cause like the least informed, the biggest, uninformed idiots in the market to trade, okay, but has no correlation with anything else. Well, Barber and Odin, in a series of path-breaking papers about retail investors, have shown that individual investors, one of the strongest and most robust effects they document is that individual investors return chase. They look at the prior returns of the stock, and if the stock was up last month, they say, oh, gotta get me some of that. Okay, despite the fact that past returns, as we all know, do not predict future returns, and in fact, the relation in individual stocks is a little bit negative. And in a recent, very nice sort of taxonomic paper, tremendously well executed characteristically by Caitlin Danhauser and Jeff Ponev, they show that the same is true in ETFs as well. Investors also return chase in ETFs, and there's really like no predictive power whatsoever. Okay, and so we find that, guess what? Your lagged return the prior month, okay, up to 5 trading days ago, is a strong predictor of the primary flow in both directions, negative and positive, into your ETF. It's driven by retail orders identified using sub-tick, sub-penny improvements in this clever recent way that's come out. And when we pull down actual numbers of Robinhood investors holding the stock on a daily basis from RobinTrack, there's this, that seems to be a big factor, that millennials on their smartphones, the ultimate uninformed investors, look at the prior return and say, oh, it was up, I'm going to buy some. Okay, that's what we want. So when we take just the predicted primary flow stemming from just these coefficients, just this coefficient, technically the 0.47, okay, and we plug that into our estimates. Now we're in terciles for reasons I won't go into, but that's fine. We actually find predicted, instrumented primary flows in and out of ETFs, okay, similarly have these big differential effects, not only on the spread, which, as we talked about before, but actually on price efficiency, on return volatility, and even on return correlation, okay? So, what we're finding is that even previously documented effects on asset markets that prior research has documented depend really, really sharply, and in fact, in some cases, even flip sign. If you look at the Hasbrouck measure of price efficiency, inefficiency, I should say, or if you look at the return correlation, it actually flips sign depending on the asset's pre-existing liquidity. Okay, so that's the model, that's the data, and that's the paper. Thanks very much.
Thanks very much, Davidson. A reminder to everyone to send through your questions on the web chat, and we will answer those at the back end of the session. Next, I'd like to introduce our discussant for the paper, which is Zhuo, who's a senior lecturer at the University of Melbourne. He has researched himself in the ETF space, so is well placed to discuss Davidson's paper. Over to you, Zhou.
Great. So let me share my screen. All right. Well, let's get started. Thanks, Carol, and thanks, Davidson, for the fantastic presentation. So I like ETF studies. I myself work on ETF for a couple of years by now. And in my past research experience, I do realize when I play around with ETF holdings, I mean, some ETFs just don't have all the underlying stocks in the index. Back then I thought it's probably just due to some kind of ETF product construction. There's some potential where ETF provider want to design its ETF product in a certain aspect. I didn't give too much thought into that, but I'm very glad that now there's an academic paper actually look into that and basically tell us something about this ETF product design. So basically, this paper in a nutshell, to me, I feel like it asks a very important question: how does ETF provider design an ETF? And the author is doing a very nice job of providing a theoretical motivation and back up by solid empirical execution. So the theoretical motivation is really thinking the ETF provider is balancing between the tracking error of the ETF versus the transaction cost of the ETF. So obviously, if the ETF provider put all the underlying stocks into the basket, the tracking error will be like minimized. But then what happens is that it kind of going to incur a larger transaction cost in trading this ETF because some of the underlying stocks are just so illiquid. Therefore, the optimal solution for the ETF provider when doing this balancing is potentially to underweigh the illiquid underlying. So give up some illiquid stocks in exchange for a lower transaction cost. Okay. That's very nice. And what's even better for this paper is that it goes one step further and asks what is the economic implication of this optimum product design, or so-called underweighing the illiquid underlying. And it turns out there'll be a Matthew effect, as David have mentioned, and it basically is a liquidity bifurcation. There'll be more liquidity for the actual holdings, but less liquidity for the underweighing ones. Okay. The empirical support is actually pretty nice. So the main empirical results comes from this following regression. So essentially, the authors project the trading cost at the stock level onto the interaction terms of the primary flow, which is the ETF primary market flow, and the liquidity group of which this stock is assigned to. Then if we look at the coefficient of this regression outcome, it turns out like beta, this coefficient of the interaction term is negative for liquid stocks. So which means the primary market flow of the ETF kind of, reduce the transaction cost effective spread for liquid stocks, enhance their liquidity. But it's a positive for illiquid stocks, okay, in the sense that this ETF primary market flow is not really helping for the illiquid underlying, illiquid stocks. They're actually hurting them and increase the effective spread of them, okay? So obviously this main explanatory variable in this regression is the primary flow, okay? And which here is, that's to be clear, the primary flow is an aggregate market variable. It's a sum of all plain vanilla equity ETFs flow on day T. So naturally, as a reader, when I read this, I ask myself, okay, what could be a drive of the flow of this ETF? Because this seems to be the key explanatory variable here. So we may want to get a bit of better understanding about the economic behind this primary flow. Okay, so it's a sum of all the primary market flow for all the ETFs. Then what can drive the primary market activities for ETF? One thing would be obviously the index arbitrage, right? The creation redemption to arbitrage index differences. The other thing that can potentially drive this primary market action might due to some kind of market making behavior. So market makers, they may use the primary market, to manage the inventory position on the ETF. So for example, some market maker may create units to cover a short position in their market making businesses by filling a previous buying order. Okay, so then if that's the case, then it's a daily flow. The daily primary market flow is potentially linked to the order imbalance of the ETF. Then the sum of all flow is kind of approximate of a market-wide order imbalance, which is what we call a market-wide liquidity. And I think this is actually a concern that the authors should try to rule out. The market, the primary flow might be somehow linked to the market-wide liquidity. The reason this is concerning is because we know market-wide liquidity has a non-uniform impact on the liquidity of individual stocks cross-sectionally. So what do I mean by that? If we take Russell 3000 stocks as a universe, and then we construct the market-wide liquidity by looking at average effective spread of these 3000 stocks. After that, we sort those stocks into 5 groups, liquid versus illiquid, Then we compute the spread difference, or you can call the liquidity gap between the illiquid group and the liquid group. Then what we will see is that when the market liquidity deteriorates, the liquidity gap will increase. Okay, so the graph here basically shows that, like you see that during the early 2000s, when the market liquidity decreased, the gap increased, and the same thing happened around the financial crisis and the euro crisis. It also, I think, it also happened recently. Okay, so I think it will be important to rule out that the primary flow is somehow linked to the market-wide liquidity. And I think a simple regression by projecting the primary flow onto the market-wide liquidity can basically rule out the concern. Okay, so that's my first comment. My second comment is some kind of link to this first comment, like maybe the primary market flow at aggregate level is a bit too coarse. We maybe want some more granular kind of level data, like to look at the stock level primary market flow. So in a sense that we should probably take one stock and look at all the parent ETFs, and then integrate out those primary flow for all the parent ETFs using the weight of these stocks in those parent ETFs. Then we construct like a stock level primary market flow coming from the ETF actions. Okay, so I think in the paper they also acknowledge that this might be a better measure to capture what they want to capture. But then the challenging will be the daily weight is hard to obtain. At least I mean when I read the paper, it's still written in that way. So, but I would suggest that perhaps we can use the 13F data, which is like a quarterly report data, to get at least the quarterly weight. So at least we don't get the perfect one, but we get something, you know, more granular than an aggregate one. Depends on the past quarter weight. Okay, so maybe that can help us to tease out any aggregate kind of market factors. So that's my second comment. The last comment I have is kind of linked to the model of this paper. So the model in the paper seems to suggest an equilibrium of like a pure strategy in constructing the ETF. So i.e. Underweighing illiquid stocks. I mean, it feels like there's only one strategy because there's only one or a representative ETF provider in the model. Okay, but then somehow in the empirical work, we have learned that, I mean, ETF providers, they don't act the same. Like some ETF providers do produce so-called sampler ETFs, so the underweighing one, but some do not. Some produce the replicator ETFs, so exactly replicating the full index. So then to me, this would suggest that maybe there's a potential gap between the model and the empirical work you've been showing here. So it feels like the theory model should be somehow incorporate this differentiation in the ETF product, suggesting that maybe the equilibrium strategy of ETF construction is some kind of a mixed strategy, you know, mixing between sampler and replicator ETFs. Okay, so that may potentially help to close the gap between the theory and the empirical. Okay, so I think all in all, this is a very interesting paper, very well written, well executed. I've learned a lot from reading it. And I do believe the trade-off of this, between the tracking error and the transaction is one of the reasons why we observe, you know, sampler ETFs, or why we observe ETF underweighing some stocks. And I think the paper can be further improved if they dig into the question, such as what drives the primary market flow. You know, from the most recent update, it feels like you guys are taking that direction. And also, it'd be nice to show or to discuss like why we see replicator and the sampler coexist in the market. Okay, so with that being said, let me stop sharing my screen.
Thanks very much, Joe.
Yeah.
So we have a few questions from the audience, so I'll go to those first, and then time permitting, give Davidson the opportunity to respond to Joe's comments. So the first question comes from Yazid Shariah from NBIM. He said, could you comment on the impact of the results conditioned on the liquidity of the ETF, especially for the ETFs that are more liquid than their underlying constituents, whether they be sampled or fully replicating?
Yeah, great. So we have not, I mean, of course, the beauty, the incredible beauty of working on ETF and market structure type stuff now that I'm now discovering is that, you know, all the data is right there, right? So more or less. So we have not looked at that conditional on the liquidity of the ETF itself. Of course, you know, the main thing that drops out of the model, the full model at the start, is that the netting effect is kind of impossible to get around. An immediate consequence of that is that the ETF must be more liquid than sort of homemade indexing, right? So yeah, I think that may be a very nice way. That gives me an idea because, we could potentially use the liquidity on the ETFs themselves to measure daily market liquidity, as Zhou suggested. So I'll take the opportunity to very quickly say that Zhou's discussion is great. And the point about controlling for sort of market-wide liquidity on a daily basis is a great idea. We have day fixed effects in our main regression. So like everything is kind of swept out and averaged out by day. So that goes some of the way there. But Zhou's suggestion is a great one. And potentially I'm thinking using the liquidity on the individual ETFs themselves, varying by day, might be another nice way to get at that. So the answer is we have not done that yet, but that's a great idea. Thank you.
Okay, great. The next question is from PK Jane from Memphis. How might the mechanical rebalancing needs for more complex ETFs like leveraged ETFs and inverse ETFs affect the result?
That's great. Thank you, PK. Our main results in all of our data, we are looking only at, vanilla US common equity ETFs. Okay, so that's not like, in our current data or any of our current results. My sense is that all of the complex leveraged and inverse guys, I could be wrong about this, so take this with a grain of salt, but when we looked at those, we found that they tended to be neither classified as samplers nor as replicators, but rather their flag is a third one called derivatives. And they operate 100% through, as we said, basically sleeving through futures contracts. And so my sense is that the same overall conclusion has to hold, because eventually the APs have to work out their position. But if they're doing it through derivatives, then maybe, the whole mechanism is just different and our model doesn't speak to that.
Okay, great, thank you. We don't have any other questions from the audience as yet, but please keep sending them in. And in the meantime, Davidson, if you wanted to comment on any of Zhou's other suggestions,
yes,
or if you've covered everything off.
Yes, thank you very much, Zhou. Terrific discussion and a lot of exactly right points. So let me see. We talked about the differential and controlling for market-wide liquidity. I think that's very important, and we can do more in that direction. Instead of using this really coarse daily net create redeem, right? Absolute value primary flow, as you say, just has a T subscript. That's a pretty coarse measure. On the other hand, we are trying to get at these aggregate across the market kind of outcomes, right? So but your point is very well taken. Using some sort of stock level primary flow sub IT sort of projection of the primary flow is a fine idea. And I worked with the 13F and the S12 data as well. And CRISP has holdings now, right? They have their own little holdings database. So that would certainly be doable. I mean, even better, I'm very proud actually. In the new draft of the paper that will be coming soon, we actually have daily baskets for most ETFs that they posted. So that would enable us to construct almost the perfect projected stock level primary flows, right? That's a huge, ugly job, programming the matrix multiplication in there. It makes my head hurt even thinking about it now. But thankfully, my dear friend and co-author Da is a PhD student, so the cost of his time is zero, and he will be happy to look into that. So the third question, or Zhou's third point that is important to talk about is, and very smart people, Zhou included, have mentioned this to us a couple times before. So this is a theme in people's reacting to the paper. Very informed people, which is they say some version of why do some ETFs replicate and some sample, right? That's just fundamentally, we're just taking that as a given. But Joe's absolutely correct. Like there's some aspect of the IO of the whole industry that we obviously are not capturing, right? Now, there's two things I want to mention there. First of all, in practice, ETFs, even the ones that are fully replicating, as far as we can tell, have effectively total discretion to define a custom basket whenever they want to whomever they want on a one-off, basis, okay? And you can tell that because there are these popular heartbeat trades where they have a fund has like a really big built up legacy position in some big asset that gets dropped out of the index, let's say, for whatever reason. And they want to optimize, in quotes, their tax capital gains treatment on that, okay? And so they do a customized, Carol is one of my APs, I just call her up and say, hey, Delta Airlines just got dropped out of the index and I have this huge position in it. Can I just define you a custom basket consisting only of Delta Airlines and just hand you that Delta Airlines shares, okay? And that way the capital gains, because it's an exchange in kind, that goes directly to Carol and she has to deal with it, okay? So, and we do observe the fully replicating ETFs in our sample carrying out heartbeat trades. In fact, Vanguard is famous for that, right? Vanguard patented a way to go about doing heartbeat trades, right? So that tells you that even though they may say on the box, we are fully replicating and so forth, they are clearly free to define a custom basket on an ongoing basis. And we suspect that that may be part of it, okay? The second thing to mention is they could just be clientele effects. My personal hero, Matt Levine, at some point in one of his columns said something like, I don't even know what he was talking about specifically, to some other like totally different topic, but he said, I suspect that the fully replicating guys, which have higher trading costs, but precisely track the index and invest in all the underlying assets, are probably most interesting to long-term investors who don't care that much about crossing a bid-ask spread, right? But they do want the exact, replicate over a sweep of like decades, okay? They would like to replicate for whatever, let's say. On the other hand, the samplers, which are, maybe a slightly noisier version of it, but have much smaller transaction costs, are probably most interesting to sort of HFT people who are trying to like rebalance their index exposure or something like this, or do hedges on a second-to-second basis, and they want maximum liquidity, right? And the lowest possible trading costs and good enough tracking error. So that's great. So my suspicion, actually, to tie it all up, is that if we put two kinds of investors, currently we have one kind of investor in our model who just cares this much about tracking error and this much about transaction costs. And my strong suspicion is that if we put two different kinds of investors with different weights on those two into our model, we might see these sort of clienteles developing, right? But that's pure conjecture as well. But thank you again, Joe. This is really helpful.
Excellent. Thanks, Davidson. One more question for you. Are there any policy implications from the paper? Is there anything that the policymakers should take out of your results in terms of any actions required?
Man, great question. So we do actually, we've thought about, I mean, as academic economists, we're always very scared of saying anything about welfare effects, right? Because it's just like, that's like sticking your neck out, daring it to get cut off, right? But it is very clear that, in the model, right, ETF providers make, it's perfectly competitive free entry, so they make zero rents on average, and they just recoup their costs. Same thing for authorized participants in our model. And that's probably not that unrealistic, we think, right? It's not like, you see stories about sort of weird backdoor deals whereby you get paid for making an index, for like just writing down an index or something, right? So, but all the numbers in those examples and those quote unquote scandals always seem really small to me relative to the size of the industry. Like it seems like they're really squabbling over like a couple of basis points here and there, you know what I mean? So one suspects that the industry as a whole is probably pretty competitive. And in the model, that's clear. That's just, zero rents everywhere. And in the model, introducing the ETF clearly makes investors better off, right? Because you know, the netting effect is really great for investors who previously had to sort of homemade index, okay, as best they could. It makes market makers, I mean, potentially you would say the returns to being a market maker may have gone down, right? In the model, market makers are also, it's just pure Kyle 85, right? And the market makers make zero in expectation. But you could think that in a broader sense, like a realistic sense, that maybe the returns to being a market maker have gone down as a result, right? And especially if you are a company or an investor whose stock of choice is one of these highly illiquid penny stocks, that market has gotten worse. And that's just a clear thing in the data, right? Like that's not our model speaking, right? That's just the data speaking. So I don't know what the answer is to that on a welfare adjusted basis, though. Like I think we are really just explaining something that has happened and is happening and will continue to happen. I don't know of a particular policy implication offhand. It's just descriptive.
Great, thank you. So let me thank again Davidson for a terrific presentation and Zhuo for a wonderful discussion. We'll wrap this session up and we'll rejoin again at 2 o'clock or on the hour, and we'll see you then. Thank you.